All right, I have it 11 o'clock. Good morning, everybody, and welcome to today's webinar, Mythbusted. I won't need life insurance when I retire. My name is Brian Lysing. I'm with Financial Brokerage. For those of you who are not familiar with Financial Brokerage, we are a national marketing organization working with independent agents and financial advisors all across the country in the areas of life insurance, annuities, long-term care, and Medicare supplements. I am one of our life insurance marketers here at Financial Brokerage. And for those of you coming to this webinar that are familiar with Art Jetter and Company, we have recently merged forces with Art Jetter. And that means that both if you're working with Jetter or working through Financial Brokerage, we have access to some more life insurance carriers than what we had previously, and you also have access to additional resources. We can collaborate on webinars such as this one right here. So welcome, no matter where you're coming to us from for this session today. And I should let you know that all of your lines are muted. We do that to cut down on background noise. You can still ask questions though, just type the questions in the comments, in the questions box that you see on your screen there. And I'll get to as many of those as I can at the end of today's webinar. And I will tell you this will not last more than a half hour at the most, and that includes the questions at the end so you can get on with your day. So I appreciate everybody taking time out to join us. Again, Mythbusted, I won't need life insurance when I retire. Where does this come from and what are we going to cover this morning? Well, this topic stems from several conversations I've had over the years with agents and advisors where we're discussing the needs of probably a younger client, somebody in their 20s or 30s, and the agent is asking me for a quote. And I'm given a face amount, and then I have to respond back, well, are they looking for term insurance? Are they looking for something permanent? How long do we want this to last? And the response is often, well, they just need term insurance. They only need this to cover a mortgage, or they need this to cover income until they retire, and then they're not going to need life insurance any longer. And that's where we have to take a step back a little bit, because there are several reasons why people are going to need life insurance at their later stages of life. A lot of times people think of life insurance for the needs that crop up when a person is younger, and they aren't aware usually of what those needs are going to be later on. And we know there are definitely needs later on because we get calls all the time for people in their 60s, 70s, even 80s. They're looking for life insurance. Well, why is that? Well, nobody had this discussion with them when they were younger to set them up for success in their older years. So we're going to help you help your clients so that they don't end up in that situation and they can get started with something when they're younger. This also helps, so if you are working with clients in, let's say, that over age 50 marketplace, and you'll have 4 great talking points to bring up with them to uncover some needs that maybe they weren't aware of that they even needed. So we're going to cover 3 things. One, we're going to talk about the needs a person has when they're younger, just to get that out of the way. We're going to talk about how those needs change when they become older, walk you through what those 4 are, and then at the end give you 2 pieces that you can use with your clients when you're having these conversations with them. So let's see here to get started. Okay, so when we're talking about young families, usually 20s and 30s, and they're talking about life insurance, what needs come up in conversation? Well, the first thing we talk about is the cost of a funeral, right? That's, I mean, life insurance when you die. First major expense is the cost of burial and the funeral. Now that might be $10,000, it might be $20,000. I have in this example here $50,000. That might be a little high today. However, if we're talking to someone who is 30 years old and they pass away at life expectancy, let's say maybe when they're 90, that's 60 years down the road. Yeah, 50,000 is probably a decent number to consider, right? So that's a need that folks will have really at any age, any stage of their life. Now, the next need we typically talk about with younger folks is the need to cover a mortgage or to pay off that house. And people realize that that's a finite need, of course, unless they purchase a second house or a new house later in life. But usually we know when that need is going to expire. And yeah, term insurance is a great product to fit in that area. Now, I have in this example $300,000. This is obviously going to vary depending on the part of the country you're in and the size of the house. The other need that typically comes up with younger ages is income replacement, right? If there are children involved, we hope that at some point in time they will move out of the house and they will be earning their own incomes. They won't be dependent on mom and dad. But until that happens, we need money available if we as the parents can no longer provide that income to provide for those children. So we buy life insurance, again, usually term, because we think we know when those kids are going to be on their own. The same thing could be said if there are no children in the picture, or even if there are, and we have a 2-income household, one spouse usually cannot provide enough income on their own, and they're relying on both incomes. So therefore, we have an income replacement need. That's something we typically take into account when determining how much life insurance a person needs. And then the fourth area we get into with younger clients is college planning. Some families will want to be able to provide that lump sum so that their children can attend the college of their choice, not have to take on massive student loans. And so that way, if mom or dad are not around to be able to help, we have the asset in place to cover that. So this is what I find a lot of people think about when they're thinking about life insurance. It's the younger ages, and it's these 4 needs that we see right here. And of course, if you're looking at just those needs, yeah, most of those are going to go away at a certain stage in a person's life. And they think erroneously that they will not need life insurance later on. Well, those needs largely go away, but a lot of things change and some other needs populate to take their place. And so this is where you can have this conversation with clients when they're younger to make them realize that, hey, we're going to have some permanent insurance built in now, or we're going to have this conversation down the road and either convert some of your term to something permanent or just replace it with a new permanent policy altogether. So what are those needs that are going to be needed later in life? Well, we still have the cost of a funeral, right? We're not going to die for free. We have to pay for that in some fashion. Now, this is something that's going to apply to all of your clients, whether they're at the high income levels or they're at the lower income levels. You know, a lot of people like to joke that, yeah, I don't need a fancy funeral, just, you know, dig a ditch in the backyard and throw my body in or something like that. And we all know that there are ordinances and laws against that. You can't do that. There's going to have to be some sort of a burial or cremation. It's going to cost money to do that. So we have to provide those funds for somebody. Some clients will look at doing a prepaid funeral plan with a local funeral home that takes care of the problem, but now we're paying dollar for dollar. Why not pay for this with pennies on the dollar by getting a life insurance policy, at least a final expense plan? If nothing else, it's going to cover that very basic need. Now, in this example, I have $100,000 listed on there, and yeah, that's more than the cost of a funeral and burial. But if you think about it, if you have a person passing away later on in life, they usually don't go suddenly. It's usually due to some medical condition. There may be some expenses associated with that that are not covered by Medicare. They're not covered by health insurance. Wouldn't it be nice to be able to reimburse the family for those expenses, or to pay for family members that have to come in and maybe visit that loved one before the end of their life, and they don't live in the same part of the country? Again, it'd be nice to not have to worry about funds at a time like that when you're already worried about a lot of other things happening. So again, in this example, we're going to allocate $100,000 to that need. And by the way, the last example, if you added up all those numbers, it came to $1.5 million. Keep that number in mind as we go through the needs of a person later on in life. So we've got the basic burial needs covered here. Well, what other needs might there be? Well, there's 3 more that we're going to cover, and one of them is, once again, income replacement. Now, wait a minute, you might be saying, we're dealing with people who have retired, they're no longer working for a living. Where does income replacement come into play? Well, there are 2 places where you might see this. One would be if the person has a pension plan from their employer. You'll see this with teachers, maybe with nonprofits, and some other industries that still have pension plans. Now, when a person starts that pension, they usually have a couple of options. They can take the full pension amount, or they can opt to take a reduced amount with the guarantee that that amount will continue to their spouse when they pass away. Well, maybe they chose the option where they get the full amount and nothing goes to the spouse. You might want to have that discussion about getting a life insurance policy to still provide some sort of income to that spouse when they pass away. And you can look at the costs and do a comparison and then see which route is better, the full amount plus life insurance, or maybe taking the reduced amount. Now, that won't affect too many people out there, but what will affect a lot of people is Social Security income. Now, this only comes into play with couples. So if you have just an individual client, you can ignore this part. But a lot of people don't realize that with Social Security, if you have a couple and one of them passes away, one check will continue after that person passes away, but not both. They do get the larger of the two checks, but you want to have that discussion and ask, look, if there was just one of you, could you make ends meet with just one Social Security check? Or do you need both of them? Do you need part of that second one? And now we're back in that income replacement conversation once again. Only now the conversation doesn't have an end date. You know, when we were looking at income replacement for a younger person in their working years, we can assume they're going to stop working at a certain point in time. With this, we don't know when both members of the couple are going to pass away. Therefore, term insurance isn't going to work. We need to get something permanent. And so this can lead to a permanent life insurance sale for income replacement purposes. All right, so the third reason people will need life insurance in retirement is to handle long-term care expenses. Now, what does long-term care have to do with life insurance, right? There are long-term care policies out there that people purchase for this very reason, and you are absolutely right. You can buy a long-term care policy to handle your long-term care expenses. However, that's not your only option for handling long-term care. A lot of people prefer a life insurance-based solution to handle this. Now, why would that be? Well, traditional long-term care, you are subject to rate increases. And it's probably not a matter of if, it's a matter of how many times is the company going to raise your rate? And what's the percentage of the rate increase going to be? I've seen clients that have gone through 2 or 3 rate increases, sometimes 60%, sometimes 90%. And at some point in time, that becomes too much for the client to handle. They either have to take an option to reduce their long-term care benefits, or they just end up dropping the coverage altogether. Now, sure, they can get in on a little bit lower price, but you know, you're kind of at the insurance company's mercy here. You don't know what to expect in the future. And a lot of people like the peace of mind of knowing that, hey, whatever price I'm paying, this will never change. I will never face a rate increase. And you can do that with the right life insurance policy. Now, another appeal of this is the use it or lose it concept, right? If you have a traditional long-term care policy, if you never use that for long-term care, the money has just gone to the insurance company. However, if you buy a life insurance policy that you can accelerate for long-term care, there is a guaranteed payout, right? The money is either going to go to you for long-term care, or it's going to pass on to your family as a death benefit, or some combination thereof. You know that that money is going to be paid out to somebody. So there's the appeal. We have rate guarantees, and we have the notion that this is guaranteed to be paid out. I am not wasting my money. It's going to somebody for the right reasons here. And you know, a third appeal to the life-based solution is many of these policies have cash value inside them that you can tap into for any reason. You don't have to need long-term care to tap into this cash, right? Maybe you want to use it. The person has not completely lost their activities of daily living, but you need a little help around the house. You need help with some daily chores, but again, you don't qualify for the long-term care. Well, this is another source of funds that you could tap into for that purpose, or really any purpose, right? You want to take a trip, you want to buy a new car. it's another fund that you can look at. And by the way, this is very appealing to the men. If you're working with a couple, usually the woman in the couple will be I guess I want to say the coverage, right? Knowing that she's covered is going to be more appealing. Whereas if you're talking to the husband, looking at that money is going to appeal a little bit more because he thinks he's probably not going to need care. Maybe he's right, maybe he isn't. But hey, let's give him some access to cash to make him feel good about the purchase, and then he'll be covered no matter what happens. So again, life insurance for long-term care needs is a big part of this. Now, the fourth reason people will need life insurance in retirement has to do with everybody's favorite topic. That's taxes, right? Everybody loves to pay taxes. Well, you might be wondering what taxes are due at death. The first thing that comes to mind is the federal estate tax. Right now, you have to have a lot of money to be subject to the federal estate tax. For couples, I believe the number is right around 25 million or so. That won't affect very many people. However, if Congress does nothing, everything changes in 2026 when the exemption limits revert back to where they were prior to the current law being in place, and that means everything will be cut in half basically. So couples worth roughly 14 million or individuals worth 7 million or more will be subject to the federal estate tax in 2026. That's still not a whole lot of people. It's probably your top clients income-wise, but you want to have this conversation with them. If you don't think you have clients that are in that income bracket or asset bracket, think again. You know, if they have a house worth $1 million or $2 million, there's a good chance they have a second house worth a little bit less. They might have some rental properties. They probably own a business. Maybe they own some land. They own a ranch, farm equipment, machinery, you name it. And if they have all that, they probably have sizable assets in their retirement plan. It doesn't take too long for an individual to get up to that 7 million mark, which is going to be roughly the threshold for the federal estate tax in 2026. Now, still, that doesn't count many of your clients. They're not going to have to worry about that. But there are some other taxes that are going to come into play. One might be the state estate tax. There are several states that impose a state estate tax, a much lower threshold, could be as low as $1 million. So check with your state to see if that applies. But the thing I think is going to affect almost everybody out there, and that's the Secure Act of 2019 and the taxation on qualified funds. Now, if you're not familiar with what qualified funds are, these are dollars that have never been taxed, right? It's pre-tax money. It's sitting in an IRA, it's sitting in a 401k, it's sitting in a 403b. I think most people that have retirement assets have the money in a 401k, right? And if it's not a Roth 401k, this money has never been taxed. It's going to be taxed when you take it out in retirement. So what does that have to do with taxes when a person passes away? Well, the Secure Act says that if you pass away with qualified funds in your name, one, they can pass to your spouse and it's treated as their qualified funds. Nothing changes. However, if you're the last spouse or if you don't have a spouse, then your heirs will inherit this money and they have to pay the taxes on it. They have to take the money and pay the taxes within 10 years of your death. Now, okay, but what does that mean? Well, if we look at the age of the heirs when they're inheriting this money, they're probably at the peak income earning stage of their career, earning more money than they ever have. They're probably in their highest tax bracket that they've ever been in or will be. And now all of a sudden they have a huge lump sum dropped in their lap, or maybe a lump sum spread out over 10 years if they want, but it's extra money at exactly the wrong time. Well, what can we do about that? Well, we can get a life insurance policy. We can estimate what that amount might be and what their tax bracket might be and get a life insurance policy to cover the taxes. Now we have tax-free money so that the heirs can inherit essentially the full amount that was left in that qualified plan. Now, you can take this one step further too. you can actually cut Uncle Sam out of this equation completely. And here's how you do it. All your client has to do is name a charity as the beneficiary of those qualified funds. Charities don't have to pay income taxes, right? So they can inherit all of this tax-free. Now, what happens to the heirs? They're left out in the cold. Well, this is where life insurance comes into play. You can get a life insurance policy in the amount of those funds that were sent to the charity, and now your heirs can inherit that amount tax-free. The charity gets the amount tax-free. Uncle Sam is left with nothing. I'm sure this would be the method that most clients would prefer to go. So those are really your 4 reasons people will need life insurance in retirement. And you can take your clients through these steps in this order, because we're starting with maybe the lowest income threshold and a need that everybody is going to face no matter how much they're worth. And then we're moving on to the income replacement for Social Security if you're dealing with spouses, and then people that have a little more assets to protect. We want to make sure they have the money for long-term care. And if we go a few steps beyond that, and they might pass away with some qualified funds intact or have enough to qualify for the estate tax, we can now take care of that with life insurance. Right, so those are the 4 steps. I mentioned we have some company resources that you can utilize with your clients. And if any of you joined us on the webinar we hosted a couple weeks ago, Corbridge Financial, you may be very familiar with the butterfly chart. And this is another way to take your clients through really the same topics that I just covered here in a little different fashion. Now, we have this available in PDF. It comes from Corbridge Financial, and you can walk your clients through this concept as well. And again, this is available whether you work through financial brokerage or work through Jetter. On the financial brokerage side, myself or Tim or Dave can certainly get this to you. And if you are contracted through Jetter, then Danielle or Kip can certainly get this over to you. Another piece that I really like to use is this analysis piece from Prudential. Now, Prudential is the only company I've ever seen that has put together a needs analysis that is specific to the later needs marketplace, or roughly the over 50 marketplace. This one doesn't talk about so much the mortgage and income replacement and college education. It talks about replacing Social Security income, money needed for estate taxes, both the federal and state, money needed to handle the taxes on qualified funds, and maybe money for a college education, but specifically for grandchildren, right? So this is a great piece to use with your clients. They're in that later stage of life to cover everything that we discussed this morning. So that is the webinar. I want to thank everybody for joining us here. I'm going to open it up for questions right now. If you do have questions on the session, go ahead and type them, and I'll get to as many as I can here.